Hello everyone, I'm Namrata and welcome back to another episode of the Basics of Mutual Fund series that we've created for all of you. So in the last video, we discussed about an introduction to debt funds and we discussed a specific category of debt funds, which is a short-term category where the time horizon for an investor could be up to 1 year. In this video, we are again going to talk about debt funds, but here we're going to talk about a relatively longer duration in terms of the time horizon, where if an investor is looking to invest for say 1 to 3 years, then which are the debt funds that he or she could invest in. Now this also because there is an opportunity available for higher capital appreciation in certain categories of debt funds. So before we proceed further, let's discuss what we really discussed in the previous video. So in the previous video, we saw that debt funds invest in debt instruments, and debt instruments could be divided into two parts. So we have short-term debt instruments and we have long-term debt instruments. Now under the short-term debt instruments category, we have instruments like treasury bills, certificate of deposits and commercial papers, where treasury bills are issued by the government, certificates of deposits are issued by banks, and commercial papers are issued by companies. In the long-term debt instruments categories, we have government bonds and we have corporate bonds. So some of the categories of short-term debt funds that we discussed were overnight funds, liquid funds, ultra-low duration funds, low duration funds, and money market funds. And all these funds invest in short-term debt instruments. Now, what are the parameters that should be used to select these funds is something that we've already discussed in the previous video. So what we discussed was a short-term category of funds, debt funds, where the time horizon for an investor is up to 1 year. But if an investor is looking to invest for say 1 to 3 years, then what are the options available to him? So in that particular case, the debt funds that could be considered by an investor are, so there are short duration funds, there are floater funds, banking and PSU funds, corporate bond funds, and credit risk funds. So now the question is, what are these funds and where are they investing our money? And the biggest question is there any risk involved? So if you look at a short duration funds invest in a combination of government bonds and corporate bonds, and they mainly invest in medium and long-term bonds. Then if you look at banking and PSU funds, so banking and PSU funds invest money in bonds which are offered by banks, public sector companies, or public financial institutions. Then if you look at a floater funds basically invest our money in floating rate debt instruments where the interest rate of the debt instrument keeps changing based on the market rate. So if in the market the interest rates are going up, then the interest offered by the floating rate bond will also go up. Then a corporate bond funds basically invest in corporate bonds but with high credit rating. So if you see, most of the portfolio is going to be invested in AA plus and above rated papers. A credit risk fund would again invest in corporate bonds but with slightly lower credit rating. So in credit risk funds, 65% of the portfolio has to be invested in AA or below rated papers. As discussed earlier, now these funds or these categories of debt funds are ideal for those investors who are looking to park their funds for 1 to 3 years. But we've still not answered the question, is there any risk involved in debt funds? So the first type of risk in debt funds is something called as the credit risk or the risk of default. And this is measured by something called as a credit rating. So basically, all the debt instruments are given a particular credit rating, which basically tells you how risky or safe a particular bond is. Now, as the credit rating of a particular bond starts going down, the interest offered by the bond would go up to compensate for the risk. The fund managers in the debt fund space really manage between this particular risk and try to optimize the returns for the investor. For example, if you look at treasury bills, which is considered to be an extremely safe debt instrument because it is offered by the government, the interest offered by them is extremely low. Now, if all the funds in a particular mutual fund are invested in a treasury bill, the fund returns may not be able to beat even fixed deposit returns. So in that case, the fund would also invest, say, a little bit of amount in commercial papers because commercial papers are slightly more risky and give better returns, and overall the fund returns would improve. So if you look at the sample commercial paper and corporate bond portfolio of ICICI Pru Savings Fund, which is a low duration fund as of 31st December 2021, You will see the names of the issuers of the commercial papers and the corporate bonds, along with the credit rating of each of those papers and the weightage given to these papers in the portfolio. In the same way, when you look at the long-term debt instruments, corporate bonds generally offer higher interest compared to government bonds. So any mutual fund which is focusing on buying long-term bonds would have a higher weightage to corporate bonds as compared to government bonds, except for gilt funds. Now the next risk in debt funds is interest rate risk, which we also call as market risk, and I'm going to explain this to you with an example. Now suppose I have a bond with a face value of 100 rupees, a coupon of 5% and a tenor of 3 years. Now let's assume next month another bond comes into the market with a face value of 100 rupees, but which is offering a coupon of 6% for the same 3-year tenor. Now if I want to sell my bond in the market, will I find a buyer for it? Obviously not, because a buyer is not going to buy a 5% coupon bond when he or she can get a 6% coupon bond which is available in the market. So then what am I going to do? I'm probably going to sell that bond to you at a discount. So instead of selling it to you for 100 rupees, now I'll sell it to you for 97 rupees. So which is basically a price lower than the face value, and this is called the market price of the bond. In this scenario, because the interest rates in the market have gone up, the market price of the existing bonds have come down. We call it capital loss. The reverse is also true. If the interest rates in the market go down, then the market price of the existing bonds would go up, and that would result in capital gains. Now, since the market price keeps changing, we call it as the market risk. Now, market risk generally, if you see, is lower in funds which carry short-term bonds as compared to funds, or is higher for those funds which carry longer-term bonds. So the short-term funds that we discussed in the previous video actually carry minimal market risk. So medium-term basket funds generally have some degree of market risk, and time is the essence in reducing this risk. So ideally look at investing for say 1 to 3 years in terms of the time frame, and invest in a combination of the funds that we have discussed to really optimize the returns and beat the FD returns in the given time frame. Here we are showing you the performance of corporate bond funds as of Jan 2022. Now if you look at the last 2 years, fixed deposit returns have been around 5 to 5.5%. Whereas if you look at funds like corporate bond funds or even other funds, similar funds in the category, they have definitely outperformed fixed deposits. Now the last basket of debt funds are the debt funds which give you capital gain opportunities. So the funds in this category are your medium duration funds, medium to long duration funds and gilt funds. During early 2020, to support the economic recovery, the interest rates were cut. Now imagine what would happen to funds which had longer term bonds in the portfolio. So had you invested in gilt funds, say in early 2020, you would have almost got double-digit returns. So the 1-year return as of October 2020 in gilt funds was close to 13%, which is equity-like returns in debt funds. And that is only possible when the interest rates are cut in the market and you have long-term bonds in the portfolio. So these funds basically invest the corpus into bonds with longer tenor or maturity. Now, as we've discussed, since the market price of the bonds are quite volatile, these funds they provide the opportunity of capital gains, but at the same time capital losses as well. So which means the interest rate risk is higher in these category of debt funds as compared to those funds which invest in shorter duration instruments or medium term duration instruments. So which means these funds are relatively more risky as compared to short term and medium term funds that we have discussed earlier. The example that I'm showing you is that of ICICI Pru Gilt Fund, and the performance is as of 31st of October 2020. Now just remember, as the interest rates in the market go up, the price of the bond comes down, and the reverse is also true. Now if you look at the current scenario, since 2020, the interest rates have been on the lower side, but now they are on an increasing trend. So come to look at it, now whatever goes up has to come down and vice versa. So now if the interest rates in the market are going up, it means the bond price of the market is going to go down, which would result in capital loss. So sitting in early 2022, it may not be a great time to invest in those category of debt funds that invest in long-term bonds because the interest rates are on an increasing trend. So what we have to understand is that when we are investing in these category of funds which are investing in long-term bonds, they are quite cyclical in nature and they perform only in a certain specific market scenario. So which means you should invest in a long duration fund or a gilt fund at a time when the interest rate is on the higher side and it is expected to go down. That is when your fund would generate good returns for you. The biggest mistake to start investing in these funds is to look at the immediate past performance of these funds. Now, had you invested in gilt funds in 2021 by looking at the performance of 2020, you would have been really disappointed because you would have got very low returns or maybe even negative returns in some cases. So to conclude, debt funds have multiple options that are available for all types of investors. So if you're looking to invest for 1 year or 1 to 3 years, or even if you're good at spotting opportunities in the debt fund space, you can actually do pretty well in terms of returns. In our next video, we're going to talk about hybrid funds. So if you've liked this video, please do hit the like button, do share it with all your friends, and of course subscribe to the Groww Mutual Fund channel so that you don't miss out on all the videos that we're going to upload for you. And if there's any topic you want us to cover, please feel free to mention it in the comment section. Of course, I use a lot of examples in my videos to explain the concept, but please understand that we are not, advising or recommending any of those products to you. Thank you so much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.